Something that's said amongst the world of real estate investors that is often wrong, but not necessarily understood to be wrong, is the simple fact that, hey, if you're gonna invest in a property, you should absolutely use a loan. Now, when most of us hear that, we're like, yeah, why not? Why not use debt as leverage so we can get a higher return on our investment? Well, the problem to that statement is that's not always the case. Matter of fact, there's sometimes where getting leverage can actually hurt the return on your investment. So in today's video, I'm going to be talking specifically about the impact of leverage in real estate. So before we kick it off, I want to make sure that we're all on the same page when it comes to financial leverage. And by financial leverage, I'm talking about exactly how much debt that we're using to purchase a property. In reality, it's actually for any investment, but we're going to talk about real estate specifically for this video. And so let's use an example right quick. Let's say that we bought a property, a nice big building for $10 million. And we went to the bank and the bank said, hey, look, we're going to give you 80% of loan to value. We'll give you a loan for 80% of the purchase price. So, all right, great. So they actually give you $8 million to go specifically to this property. That $8 million is debt. It's leverage. And the reason it's called leverage is because now we can only bring $2 million to the game, right? $2 million to the table, but yet we still own $10 million worth of an asset. And if you're not familiar with the Archimedes quote, he says, if you give me a lever long enough, I'll move the world. But the same thing applies with debt, right? If we have enough leverage here, it makes it a lot easier for us to stretch our dollars. Now, before we dive into the actual calculations, we have to understand why is it that we use debt in the first place. And there are three main reasons, but there could be many. I mean, one of them, for example, is maybe we don't have enough cash. We don't have enough capital to actually close. So in that example where we had that $10 million property, we ain't got $10 million in the bank, man. We got $2 million in the bank. So therefore, we're gonna get leverage so we can close on the rest of the property. Or we actually have $10 million in the bank, but we don't want to put all of our eggs in one basket. We don't want to put $10 million into one single property. We'd rather use leverage so we can put $2 million into 5 different properties. This is a great way to acquire essentially more with less. And another reason we use debt is because it's very popular for increasing our rate of return. However, here's the warning. The benefits of debt says that it has the potential to increase returns. Now, this is a very popular topic for a debate. I mean, oftentimes when I'm speaking in front of an audience or I'm teaching some of my students, I always ask this question and the answers vary. Do you think using more debt increases your risk or decreases your risk? Now, some people, they're gonna say it decreases your risk. I mean, let's think about it. If that's the case, well, hey, look, if I borrowed more money and I put no money out of my pocket, well, if this property foreclosed, then in theory, I lost no money. And although I can understand that approach, that's a half-baked truth, right? There's definitely some more consequences and you're definitely losing some money. Now, on the other side of the coin, people say, yeah, man, if I increase my debt, then I'm increasing my risk. I mean, let's think about it. If I have more debt to pay, well, then I'm at risk if all of a sudden I can't cash flow, or if I miss a payment, or if the bank just says, hey, look, man, I'm calling the loan due. You owe me all of my money now. And as sophisticated investors and financiers and finance specialists, we're going to see increasing debt as also increasing risk, right? Because we don't want to lose that asset. There's so much value in that asset beyond just the money we put in. I mean, we have the depreciation, we have the growth and appreciation, we have the cash flow, and so many other things. So in reality, we do not want to lose that asset. So it's an increased risk for us. But I tell you, man, every time we have this conversation, somebody always believes one side or the other. So I'm really curious, what are your thoughts on leverage? Do you think that it's more risk if you have more debt, or do you think it's less risk? Just let me know in the comments below. But now let's transition over to the impacts of leverage. Now, when we look at the impacts of leverage, there's 3 primary categories. Either we're gonna have a positive impact, we're gonna have a neutral impact, or we're gonna have a negative impact. And so if you're looking in the commercial real estate finance world, we're gonna call it favorable, neutral, or unfavorable. And essentially what that means is if it's a positive or favorable, that means it's actually helped our return increase. Neutral just means that it's stagnant, regardless if we use debt or cash, it's the same return. And then unfavorable means that by the using debt, we actually get a worse return. So we're going to put a pin into that and come back to it later. But first, let's think about what exactly does leverage impact when we're thinking about our metrics, right? What about the deal changes as soon as we start to introduce some more leverage? And the biggest one that probably comes to mind is how much money you actually have to bring to the table, right? What's your down payment? And absolutely, by using leverage in that same example we used before on a $10 million property, if we got a loan of $8 million, well, now instead of bringing $10 million, we only need to bring $2 million. And if you're anything like me, I want to spend as little money out of my pocket as possible. However, we got to think, what does that debt also affect? And I mean, if we now have debt, that means we now have a mortgage payment of some sort. So whatever type of income we're making is going to be chopped up, right? It's going to affect our cash flow. And this is seen most commonly if you're going to do something like a cash on cash return, where it's saying, hey, how much cash did I put into the deal versus how much cash did I get out? And oftentimes this is where the analysis stops with some real estate investors. And so most likely they're going to say, yeah, you know what? Because I put in less capital, I can take less cash out and my return increases. That's just barely touching the surface. And don't worry, I'm going to show you step by step how you can figure out all of the details. But before we do, let's talk about the third thing that is affected by debt, which is your sales proceeds. Now, this may be like a no-brainer, right? But in all reality, when you go to sell a property, you're going to sell it for, let's just say you sold it for $10 million. Well, that $8 million still needs to be paid back. And even if you paid a small portion of it, right? Let's just say there's $6 million left. You still have to pay the remainder of that loan before you walk away. So your sales proceeds of what you actually get to keep will also be affected by the debt. Now, sales proceeds is another metric that we're going to look at our total return on our investment. Now you can start to see that, you know, what's on the surface, there's always something a little bit more. And oftentimes that's the same concept when it comes to debt itself. And what I mean by that is people tend to think that when we think of debt, there's one way to measure it. And that's saying how much compared to the value of the property. And so a great example, let's go back to that 8 million to the 10 million, right? So if I want to buy this $10 million property, I bring in 8 million, which means it's 80% of the loan to the value ratio, right? So we just do 8 million divided by 10 million equals 80%. And that is just one process in how they actually measure debt. Now, when we get into investment properties, that is going to be one piece, but that's not the end of the puzzle. The other portion, they're actually concerned with the cash flow and how well that cash flow can then pay off the monthly debt that you're required to pay. And the way that they calculate that is through a DSCR, or it's a debt service coverage ratio or debt service credit ratio. Now, what this is saying is, all right, well, how much income does the property actually bring in compared to what our monthly debt is? And so, a quick example, let's say the property brings in $1,250 a month. Well, then it's divided by the monthly debt of, let's just say, $1,000. Well, in that specific scenario, the DSCR is going to be 1.25. Now, those are the two most common, all right? However, there's another way, and it's just simply called the leverage ratio. So instead of taking the debt to the property value, like you would see in loan to value, you're actually going to take the property value compared to the equity to come up with your leverage ratio. So we'll use that same example here. Let's say the property is worth 10 million and our equity portion, the amount that we put in, is only 2 million. Well, that 10 million is 5 times the value of the 2 million that we put in. So therefore the leverage ratio would be 5 to 1. Now you most likely will not run into that as being the operator or the landlord yourself, the investor, but just understand if that does pop up down the road, leverage ratio is a way that some financiers are going to look at the asset. Now we get to the fun part. You're probably wondering, all right, Mike, this is great information, but how do we actually solve to figure out if it's favorable, unfavorable, or neutral? And that's exactly what we're about to get to. But you know what? If you find this stuff valuable and you want to continue to support Mike, you know what to do. Go and hit the like. Okay, enough of that. I really appreciate it. But let's start talking about the thought process behind this. What it boils down to, plain and simply, is we're going to have to evaluate the property with financing and without financing. Now, although the concept is simple, I want to make sure that I give you the tools that you need so you can go out there and really start to break apart these deals to make sure that you're getting the return that you're looking for and you're making the best decision with debt as well. Now, with that being said, let's talk about how we would do it without financing first. Now, this is pretty straightforward. We're going to make sure that we consider all of the other expenses with the property, management fees, utilities, so on. And then we're going to get our cash flow. From that cash flow, typically there's nothing else that we have to take out. So we can use that NOI right from there to determine our overall value. And NOI, by the way, just stands for net operating income. Essentially, at the end of the year, how much money do you have left after all your expenses? Now, depending on your investment strategy, you may be in a buy and hold scenario forever. A lot of people are in the idea of recapturing their equity and putting it back out there to gain more on their investment, right? And so what's made common now is called the BRRRR, buy, renovate, rehab. I messed that all the way up, but you know what I'm talking about. Buy, I'm gonna get it right. Buy, you renovate, you rent, and then you refinance, and then you repeat. See, I told you I was gonna get it right. Now, that's a sexy term that has been really brought up over the last couple of years, been popularized by Bigger Pockets, but this is something that's been in practice, especially in commercial real estate, for a very long time. So this concept of being able to refinance or to sell and take the equity and move it somewhere else is not new. And so with that being said, typically when you're evaluating your overall return on your investment, you're not only looking at the cash flow throughout the years, but you're also looking at your sales price, right? And in order to get the sales price for an investment property, we typically take that NOI, that net operating income, divided by the market cap rate, all right? And basically it's saying, what are these properties trading for right now? And that gives you your value. Now, when you do it that way, with all of that information, you can actually solve above and beyond cash on cash return. You can actually solve for an internal rate of return. Now, internal rate of return can be a very confusing thing, but for all intents and purposes, internal rate of return takes in all of the cash flows, right? From the time that you invested into the property, the cash flows you generated over, and the proceeds from the sale to determine how much you actually made on your investment. And yes, that's an oversimplification, so please don't come at me in the comments. All right, I can make a whole nother video about IRR if you'd like. Now, after you understand the concept of IRR and you can kind of do your own math there's one more layer to this. And yeah, we're still on the no financing. The next layer is to identify your tax rate. Now hold on now. Don't come at me because I said some taxes. Yeah, and maybe another layer that you're not ready for. But you know what? In all honesty, most investors don't go this far when they're looking at the overall impact of their investment, right? We have to think about this though. If you're making $1 million, $2 million off of this investment, compared to somebody else who's making $20,000 or $10,000 off of an assignment fee, who is going to be more affected by the taxes, right? Now, yeah, we're only talking capital gains in this manner, but now let's look at somebody else who has a bunch of different things going on in their life that may be taxable or non-taxable, to include life insurance policies, retirement funds, 529 accounts for their children, and all these other things. We want to know ultimately when we invest, what's going to be the overall return for us as the individual investor. Now, this one piece of advice right here can literally change the game for you and have you elevate so much more by maximizing your understanding of what you're actually getting back. All right, but I digress. So after you figure out your tax rate, right, we want to find the effective tax rate. Now, the effective tax rate is your percentage that you end up paying on your taxes. And the reason this is important is because let's say you did make that $10 million sale and you got this $10 million in revenue, right? Top line income. It doesn't mean that you're actually being taxed on all 10 million. And so we want to find our effective tax rate. And one of the simplest ways to find your effective tax rate is where you're going to take your before tax income, you're going to subtract your after tax income, and then you're going to divide that number by your before tax income. All right. So let's use this as an example. Let's say your before tax income was $100,000. Now your after tax income would be $75,000. So the difference would be that $25,000, and we would divide that by our before tax income of $100,000, which would give us an effective tax rate of 25%. And yes, all of this ties into how we figure out if the impact of leverage is good or not. So now you've done all of this for no financing, right? This is 100% cash deal. Now we obviously want to move over to the financing side. Now the first step here is to really identify the loan terms, right? What is this financing, leverage, debt situation? What does it actually look like? And remember now, this is two parts. And we've already talked about it earlier, but one, we do have the loan to value, but two, we also have to solve for the debt service credit ratio or coverage ratio, right? The DSCR. And the reason why is because, again, lenders want to make sure you can make those payments. So lenders typically will tell you what coverage ratio they're looking for. Now, a common general rule of thumb that has been preached for the past couple years is roughly about 1.25, and that is a good baseline to go for. However, every lender's different. Some will go for 1.1, some want 1.3, so forth and so on. But 1.25 is a good general rule of thumb. So here's how you actually figure out the loan amount even before you actually have financing in place, right? So this is like, imagine if you're doing this deal analysis from the front end before you ever buy the property, you're doing this process to see if you should use leverage or not. Well, when we go out, we know the purchase value, we know the NOI, right? We have that information. Now we have to figure out how much of a loan can I get? And so the first step is figuring out the LTV, right? Now you should know your lender that you'll be using, and they'll tell you exactly how much their LTV is. And let's just say it's 80%, right? So we got the $10 million and they're willing to give you $8 million. Okay, great. But that's only one part of the equation. We now need to figure out how much we can get based on the DSCR, right? That coverage ratio. So what we're gonna do is we're gonna figure out that lender's coverage ratio. And let's just say it's 1.2. All right, fine. Well, now what we're gonna do is we're gonna take the NOI from the property and we're gonna divide it by the debt service coverage ratio. Now, what that does for us is that tells us, okay, based on this debt service coverage ratio, I can't even speak, but you get my point. This is our annual debt service. Essentially, this is how much we can afford to pay to make payments in as a debt. Now, based on that annual debt service, we can throw this in to start to identify how much the max loan amount would actually be. And if you're using a financial calculator, or if you're using some of those PV present value type functions, essentially what you'll do is you'll take that annual debt service, you'll divide it by 12, and that will give you your payment, right? Your PMT. Then from there, you're gonna take the years that the loan is going to be in existence. So let's say it's a 30-year fixed mortgage. You're gonna take that, you're gonna multiply that number by 12, which will give you 360, and you're gonna plug that in as your your numbers. Then you're gonna plug in your interest rate, and you're gonna solve for present value. Now, before I move on, if that was a bunch of gibberish, obviously you guys saw it on the screen here. We're specifically talking about financial calculators or potential spreadsheets that you built out to do some of these numbers. Now, again, if you're not really into the finance space, don't stress on it. I just want you to understand the process behind it. And if you guys are finance nerds like myself and you want to get a whole nother video on essentially how do these financial calculators work, or how can we put this into an Excel spreadsheet so I can run the same numbers, please let me know and I'll make it happen. Now, with all that out the way, we have our two different loan products, right? Or our two different loan numbers. We have our loan to value, and then we have our maximum loan based on the coverage ratio. Now, we're gonna have to choose the lower of the two. And the reason why is because no bank is gonna go on the higher. That's it, plain and simply. So by understanding which one is the lower of the two, now we've identified exactly what our loan amount is. Now with the loan amount in place, we can start to identify how much money we have to put down, what's gonna be our cash flow, all of these good things. And then we're gonna step back to exactly what we did with the no financing evaluation. Now we're gonna figure out our before and our after-tax IRR. And we're also going to look at our effective tax rate with finance. And this is the crescendo, because this is where you figure out if the impact of leverage was actually good or not. And so let's walk through an example here. Now for this sample, I'm going to use a simpler method of evaluating just so we can make sure that we follow the process and understanding really how do we figure out that impact of the leverage, right? So for our example, we're gonna say there's a property out there and the purchase price was $100,000. All right, well the NOI, right, our net operating income that it produced was $8,000. Now we're gonna say this is it. This is simple. We're gonna keep it straightforward right there. If that was the case, we paid $100,000 and we got $8,000 back every year, well, our rate of return would be 8%. So now we got the without financing out of the way, right? We got that out of the way. Now let's just focus on with financing. And so in this situation, we're gonna add in a few more numbers. And yes, I am gonna walk through the financial calculator so you guys understand the process and how you can walk through it as well. Let's say same scenario, okay? This NOI was $8,000, all right? And we had 80% loan to value, so the loan was $80,000, and after all of our debt service, our cash flow was $1,600. And for this example, that $1,600 is for the whole year. Now we go to sell the property, right? We got that $100,000. We're gonna subtract our loan amount of that $80,000, and that's gonna give us additional cash flow of $20,000. So now at this point, We're trying to evaluate our rate of return, right? Which is going to be a percentage. And so in the financial calculator world, we're going to be solving for interest, right? What is that percentage that we're going to be getting back, right? So I'll go ahead and put the inputs here, but we're going to take our present value, which is that $20,000. And I'll be sure to put the numbers up here as well. So when we think about this, right, we're going to find out our present value. How much money are we putting in today? And if we look at the loan product, right, 80,000 out of 100, that means we're putting in $20,000. Now, as far as payment goes, well, we're going to be getting about $1,600 a year. So that's going to be our payment. And then when we're looking for future value, well, the numbers displayed in this example is going to be that 100,000 minus 80, which is going to be exactly $20,000. Now in this example, so we can get down to percentages here, I'm going to say the holding period was 5 years, okay? And so we can put 5 in for n, right, number of years, and then we solve for our interest. When you plug all of that in, that interest amount basically saying, hey, look, this is our rate of return with financing, comes out to 8%. So if we look at before leverage, right, before any debt, then we're gonna have 8%. But we just showed here with financing in this unique situation, it comes down to 8%. And in this very specific scenario, it would not be favorable or unfavorable to get financing. It would just simply be neutral, right? There's no effect, there's no positive, no benefit when it comes to the return on our investment. But since we are savvy investors ourselves, let's think about this. If we're gonna get the same interest rate anyway, right, what are some reasons why we would want to use leverage instead of not using leverage? Well, we already talked about it a little bit earlier in this video. Maybe out of this so-called 100,000 I have, maybe I only want to put 20,000 down so I can put $20,000 in other properties, right? Maybe I don't want to put all of my eggs in one basket. Or maybe I just really like holding on to cash and I don't want to throw that much money into the deal. So understanding that leverage does not always mean a greater return, that's really the basis of it all. But there are still positives, there's pros and there's cons to both of using leverage versus not using leverage. And hey, now you know. So I know I threw a lot at you, but if you actually enjoy content like this, it's a little bit more detailed, or maybe you're interested in learning some of these different financial calculator functions, then definitely let me know. But if you did enjoy this, then you will most likely enjoy my real estate tips playlist, which we'll put somewhere over here. See you in the next video.